Hi, Stu Stover again. Wanted to get back to you with a really important topic. And some of you may not realize how close we were to a Great Depression again, but we were very close in terms of unemployment and just the devastating effect upon our economy. And for those of you, obviously, you weren't around aware of what was actually going on, but if you talk to your parents, if you talk to your relatives about how consequential this was, they probably will tell you some really harsh stories. So we had an astonishing number of people that were affected, either lost their jobs, lost their life savings, lost their houses. I mean, it was devastating stuff that we went through. And so it's important to understand what was going on there and what caused these kinds of problems for our American society, because we thought we were past all this. I mean, we thought we had the Federal Reserve, we thought we had a banking system, we thought we had all of the pieces in place to prevent these kinds of horrific consequences for our society. So let's back up. The events leading up to this. All right, so the Federal Reserve, which was Alan Greenspan, was the head of the Federal Reserve at the time. He was in a self-congratulatory mode right before this transpired. So the meeting right before this hit, he said, "We have solved the problem of the economy. We've kept inflation low, we've kept unemployment low, interest rates are low, and the economy is booming along." We'd had a very long stretch, about 5 years, of constant growth. And so everything looked wonderful from his perspective as the bottom was about to drop out. And so one of the things that was going on was something called housing. Surprise, surprise. So not just Democrats or Republicans, both administrations were convinced that if we can get more people into owning their houses, that's really good for America. So why is it good? Excuse me. Why is it good for America that we have more people who own their house? And so the logic is it forces them to have stability. So they got to keep their jobs and they can't be hopping around and they got to be committed and good employees, all that stuff. But it also means that if you own your house, you're going to have to maintain your house. You're going to have to do the other kinds of things that, kind of talk about as adult responsibilities. And the assumption is that the higher this percent of people who own houses was, the better off for America. Well, the problem with that is that you get an awful lot of people who don't have the means to own a house for a wide variety of reasons. And frankly, from an economic standpoint, one of the things we talk about in Econ is that a capitalist system needs mobility. Okay, now mobility in several senses. So one kind of mobility is as people moving up or down the economic scale. Okay, so they make more money, less money. That has to be part of the capitalist system, that is there. Mobility also means the ability to move from one job to another. Pretty important for a whole host of reasons. But a third piece of mobility is that if there aren't any jobs here, what should people do? They should jump in their cars and move to a state where there are in fact jobs. Michigan is historically notorious for that because we have historically been so dependent upon the automobile industry, and in down times of the automobile industry there aren't jobs. People go to Texas or California or North Dakota or wherever they go for economic opportunities. Well, if you own your house, that's hard to do if you can't sell your house. But if you're renting, it's not that big a deal. Move around, whatever. Anyway, so you had all sorts of programs that were designed to help people get into their own house. You had a bunch of banks. Probably one of the worst was Washington Mutual, which is gone now. They died in this Great Recession. But Washington Mutual focused on getting people into houses. And not only was it a 0% down, so you buy your house and you don't have to put any money down, they actually did get some money back when you buy a house. And so you get, say, 125% mortgage on your house. Okay, that's great. So people go take a vacation. It's, in essence, found money, and so you can spend it kind of however you want. But if people don't have jobs or enough income from their jobs to be able to support that mortgage, nothing good happens. And so Washington Mutual had a system where you had the mortgage lenders that were incentivized to write mortgages. And so they made more money if they did more mortgages. Well, you work through all your good customers to get them into housing. Well, then you do the less good customers, and you do the less good customers. Pretty soon you're dealing with customers that really shouldn't be owning their houses. So that was very much part of what was going on. And so let me kind of finish that story. So here's the mortgage lender, that person who's sitting at that desk making money off writing all these mortgages. They get money in their pocket, big deal. So one of the terms we typically use, which is a very important term, is something called moral hazard. Okay, so if the loans went bad, were there any consequences to the guy who wrote the loan? No, because what happened, it went to the next level, they did their stuff. Eventually, through the process of how Wall Street was functioning in those days and the finance industry was functioning in those days, eventually a lot of these mortgages would get bundled together and they'd be called asset management funds, whatever. They had a bunch of different names for that. But the idea is that how could you lose if you're investing by buying mortgages? That's a no-brainer. That's, automatic money. Well, the answer was, if they're bad mortgages and there's enough of them in there, they're not money. They're a problem. And so you had companies on Wall Street, a bunch of them, that were bundling all of these bad assets and selling them as if they were good assets. Is that a problem? How would a customer know that those are bad assets? There's really no way to know. So it's taking advantage of gullible people. Well, gullible. How are you going to know? How would you get that kind of information to be able to make good decisions? The answer is it'd be tough under the best of circumstances. So we had a number of companies that sold all these things, and then when the Great Recession hit, you had all of these houses that were foreclosed on. So the bank gets them back, but in a Great Recession with high unemployment, all the other problems, who are you going to sell these houses to? And so banks got hammered, and you got all these people that that ended up having bad credit because they lost their house. Many of them had jobs until the Great Recession hit. All of a sudden, they're economically in distress, really serious distress kinds of problems. Lots of issues that we could talk about with that. But we had these companies that were just making money. They didn't care about the ethics of what they were doing, which is the moral hazard. So if you can pass the risk to somebody else and still make a pile of money, yay, what a deal. But somebody is going to have to bear the cost of this. So you had housing, just the incredible pressure to get more and more people into housing back in that era that really triggered this stuff. And then you had bad actors like Washington Mutual and a number of Wall Street firms that got into this stuff. So what was George W.'s response? So most people today think that Obama badly managed the Great Recession. Well, the answer is it was George W.'s recession. And so he was the one who came up with something called TARP. All right, so what's going on here? Troubled asset, whatever the RP stands for. And so what this was, it was a pile of money that was designed to loan out to troubled businesses. So this included, at the time, General Motors, Chrysler, big banks, all sorts of businesses took advantage of this money to stay afloat. Because General Motors was within, an eyelash of going belly up. What would have happened in Michigan if General Motors went belly up and all of the tier 1, tier 2, tier 3 suppliers that supply to General Motors that also gone belly up? We would have been in far worse shape if General Motors had gone belly up. So we loaned this money to all of these companies to keep them afloat. So what's going on? So General Motors, all of a sudden, they watched their sales dry up. Okay, so what's going on here? It's called consumer confidence or consumer sentiment. The idea is that if the economy looks bad, what will you and I do as rational economic players? We'll stop spending money. Okay, so now we're not going to stop spending money on diapers and milk and bread and consumables, but we will stop spending money on durable goods, which is refrigerators and cars and all the other major expenses that typically you would finance those kinds of expenditures. And so all of a sudden General Motors isn't selling cars. Well, they don't have a reserve of cash to tide them over until we get to 2011 and get back to more normal economic conditions. Because consumers were looking at the future and they're going, I can't spend money because I don't know that the future is bright. And you spend money, you borrow money when you think that you can repay it back. I mean, that's the premise of student loans and car loans and all the other stuff, is that you may not have all the resources right now to repay those loans, but the idea is life gets better, you get a better job, you have more income, and you can pay it back. Not a big deal. What were people doing? Consumer confidence had plummeted, so people were not buying cars. General Motors didn't have the reserves. It's another story to explain why they didn't have the reserves, which was in many ways very painful. So one of the things that Obama did is he created a stimulus. And so this is what is called fiscal policy. And fiscal policy basically means it's the power of government to try and affect the economy in some way by either spending or not spending or whatever. And in this case, we're spending a lot of money to try and stimulate the economy, to get people back to work. Once people get back to work, what do? They got money in their pocket, they go spend it. And so the idea is you get an upward spiral as opposed to a downward spiral that you get in a recession, a bad recession, or certainly in a depression. So he took a ton of heat, and some of it deservedly, much of it maybe not so much. But one of the ideas was that we have to have a banking system. We have to have these mega banks. Now, I've always been nervous of mega banks, and there's history of why we used to not have mega banks. We just had regional banks, and then we changed the rules and allowed the mega banks, the Wells Fargos and the Chase and the Bank of America and all of those. And so what he chose to do, the two of them actually, is they chose to bail out the banks. And so to keep the banks solvent. So we loaned them money. So again, the current history on this is completely wrong. These were loans. And so the government actually made money on TARP. And so it wasn't a bailout. We just didn't hand money to all these companies. Now, to be fair, you hand money to General Motors, and if they had still gone bankrupt, that money had been gone. But they didn't. They came back, obviously. And so what Obama chose to do was bail out the banks. Well, what did that do? It left all this housing out there with nobody in these houses. What good things happen to empty houses over time? Nothing good. Lots of implications for that. And so he had a choice, particularly Obama. So we could bail out the homeowners and help them, or we could bail out the banks, or some combination. And for whatever reason, we made the decision that we had to bail out the big businesses and the big companies, and the premise being too big to fail, meaning if they failed, the consequences would be too dire for America. So that was the strategy we took. Now, you can argue either way. I mean, there's reasons that makes sense. There's also reasons that maybe it would have been better if we bailed out citizens, but anyway. So what did we learn from this? Number one, we learned that at every turn, Wall Street and the finance sector is always looking for ways to sort of game the system, to figure out quicker, easier ways to make a pile of money. And so what we had to do was come up with something called the Dodd-Frank bill. Okay, pretty weak, and didn't actually solve the problem, and we've obviously watered down Dodd-Frank ever since this happened. So we don't have all of the rules and procedures in place to prevent this from happening again, because we got some people in this country who are convinced that the free market system will correct itself, and that none of these things could ever happen again. Well, they keep happening historically in America. So one of the things we learned is Dodd-Frank was a way to tighten up some of the rules to prevent some of the abuses in our financial system. And again, back to protecting the customer again, the citizen in some sense. So that's one of the things we learned. We also learned a number of other things. That in fact, not everybody should have a house today, and that there are good reasons to have a down payment. Down payment means you got skin in the game, and you're not just going to walk away from it. We called it underwater property. Underwater, not because it's underwater, but you owed more than you could get for it. And so a lot of people just bailed on their houses, and they couldn't afford their mortgages. They couldn't afford to, be responsible in this way, and so they just walked away from their houses. Well, the banks have now got all this property that they can't sell. And so we learned a number of things about how to protect the banking system. The biggest lesson, in my opinion, is we learned that the Federal Reserve, who was simply focused on unemployment and inflation, they discovered there are a couple other factors that can tank the economy. And unfortunately, we have seen this numerous times in American history where Wall Street starts playing games, and they're making quick profits, piles of money is landing in various folks' hands, and yet the consequences, the moral hazard to the rest of society can be very dire. And so we learned a number of things about how the Federal Reserve needs to sort of broaden their perspective a bit as they look at managing the national economy. This is hugely important. I don't want to minimize any of this stuff because all I've done is give you a thumbnail sketch of the issues that showed up here. We do not want this to happen again. Guess what I heard the other day? A bank was offering a no down payment, actually it was Rocket Mortgage, was offering a no down payment option for buying a house. I'm going, oh, because I think there are good reasons to have down payments necessary for a variety of reasons so that we don't fall into some of these traps again. Thank you very much. We'll pick up some other topics next time.